Did you know that price to earnings ratio is one of the most popular indicators out there? Chances are you would know about it, you may even be using it, and there is a pretty strong likelihood that you may be using it incorrectly. And it is not your fault. Well, if you see most of the videos out there, will start off by defining that price to earnings ratio is a ratio between price to earnings, where price indicates the market price of the stock, whereas earnings represent reported earnings per share. These videos then go on to explain the calculation using a company A, company B example where one is 100, the other's price is 200, and earnings are 10 and 20. Well, you get the gist of it. And by this point, you decide to close the video, and this is all that you remember of price to earnings ratio. And if you're lucky, you would remember that if the price to earnings ratio is high, the stock is overvalued, whereas if it's low, the stock is undervalued. But seriously, are we here just to understand the calculation? Or are we more interested in understanding what it represents? Or why do we even use price to earnings ratio in the first place? So, in most simple words, what this ratio is telling us is how much are people willing to pay for this stock as a multiple of its earnings. I know that it may be difficult to visualize this, so let's use a different indicator that will make it easier for us to understand. We all know dividend yield. What is dividend yield? It's dividend as a percentage of its price. Or again, in simple words, it is the price that I am willing to pay to get that dividend. So, for example, if the dividend yield is 10%, it means that I am willing to pay 10 times the dividend that I will get. Or if the dividend yield is 5%, it means I am willing to pay 20 times the dividend to get that particular stock. So now if we come back to our example of price to earnings ratio, it means a price to earnings ratio of 25 would represent my intent to pay 25 times the earning for that stock. And similarly, if the price per earnings ratio is 15, I'm willing to pay 15 times earnings of that stock. Let's take this a step ahead. So this means if my price to earnings ratio is to be maintained, then every time my earnings go up, price should go up. Or on the other hand, if the earnings go down, the price should also go down. Only then the price to earnings ratio can be maintained. So now let's take a step back. Remember when we said that price to earnings ratio is a ratio of price to earnings, where earnings are the reported earnings per share. This means that we are using current market price but referencing it against reported earnings, which is past earnings. So that makes our indicator a lagging indicator, or in common market terms, it's called a price to earnings ratio, the trailing 12 months information. What about efficient market hypothesis, which states that share price should reflect all information that is known to the market? And to some extent, there is enough information known about the stock and the company to predict its short term future. We therefore have a different version of price to earnings ratio known as forward price to earnings ratio. And what it does is instead of using the reported earnings per share, it uses the projected earnings per share, or in simple words, the earnings per share that the market expects a company to report in coming quarters. And as I keep on saying, if you need to understand a company, you need to understand the trend of its results. Let's come to our main question. What is the right value of price to earnings ratio? Unfortunately, there is no magic answer to this. However, there are a range of factors that we can use. The first factor that greatly influences the price to earnings ratio is the industry to which the stock belongs. Usually, there would be some level of similarity that you will find across the stocks that belong to a single industry, and therefore it's not recommended to benchmark price to earnings ratio of a company that is from one industry versus a company that is from another industry. And this is typically due to the range of factors that are common between the companies that belong to a single industry. Now I will use stockanalysis.com and its feature to review stocks by industry. Here we have the option to review them either by sector or industries, and you can review a range of indicators at an industry level. So for instance, we can review here the price to earnings ratio, how it stands for all companies that belong to that particular sector. Or for instance, if we review this by sector, We will have sectors such as financials, technology, energy, utilities. Let's focus on a few of these sectors, and here you will see that their price to earnings ratio are quite different. For instance, technology, typically you will see really high price to earnings ratio, whereas in comparison, financials or energy sector would have typically much lower price to earnings ratio. And this is in some cases despite of the high dividend yield these sectors provide. Therefore, it is safe to assume that dividend yield is not the only key factor that investors are looking at. Brings us to our second factor, which influences the price to earnings ratio, and this is the potential of future earnings growth. In order to demonstrate this, I've selected a few companies which include Nvidia, Microsoft, Apple, Bank of America, and United Airlines. There are a few key dimensions that we will look at. The first one being the industry, the second one being the return from the last 5 years. Then we will look at a range of revenue, which is revenue growth in the last 5 years and the revenue growth expected in the next year. And similarly, the earnings per share growth from the last 5 years and earnings per share growth for next year. And finally, we will look at price to earnings ratio and forward price to earnings ratio. Airlines have always typically been a challenge sector, largely due to the impact from cost and dependency on volume. And as you can see right now, we see a really poor performance on return of last 5 years. And at the same time, the earnings per growth and revenue growth expectations also don't tell us a very strong story. Now, as you move to the technology companies, you will see a very different story. Look at the return from last 5 years. Really strong performance across the board. And similarly, the market expectation of revenue growth and earnings per share growth is really strong. You can also see that the price to earnings ratio is higher, which would at first look give you a feel that the stock is really high priced. However, when you look at the forward price to earnings ratio, this is reasonably lower than that. That basically means that market has high expectation of earnings growth, and it is right now pricing it based on future earnings and not past earnings. And the final factor is how sustainable are the results. Therefore, we cannot just look at one result as a standalone. Let's say, for example, there's a company that uses uranium as an input material and it's sitting on really high inventories of uranium, and for some reason the uranium price goes up. In this case, the company should be able to provide really good results for 1 quarter. But are these results sustainable? Well, not really, because it was sitting on a tailwind coming from high increase in commodity price. However, that cannot be continued because in future it would have to procure uranium at a high price. Therefore, if one-off results may not be a true indicator of market sentiment or expectation of future results. Let's move to our final section where we'll try to demonstrate the relationship between price and earnings, and also at times why does the price move significantly following the results posted by a company. Okay, let's try to visualize this. Let's assume we have a company which delivers consistent earnings per share and therefore its price remains consistent as well. This will give us a really stable price to earnings ratio. Now let's assume the earnings per share of this company will continue to stay on the same level of performance in future, and if we want to maintain the same price to earnings ratio, it would mean that the price of the stock will continue to be the same as well in future. Now let's assume a different company. For this one, it has been growing its earnings per share quarter after quarter, and the market expects this growth to continue. If this stock needs to maintain its price to earnings ratio, the price will also need to continue growing in line with the earnings per share. Unfortunately, when this company reports its next earnings, they come in much lower than expectation. Now, if this stock needs to maintain its price to earnings ratio, what would happen? Well, it doesn't take much to understand that the price would need to correct itself immediately in line with the earnings per share, such that the price to earnings ratio can be maintained. And some people may jump at this stock at this moment, thinking that it's the point to buy the dip. However, to make matters worse, it was just not one quarter that was badly reported. The company also expects the headwinds to maintain, and which means the future results may also be impacted. This means that the price would likely go even a further correction in order to absorb this new information available. Well, it wouldn't have been so bad after all. However, we know that price to earnings ratio is not just a calculation, but it indicates the price that the market is willing to pay for these earnings. And following this performance, the market may not be as willing as it was before to pay such a price premium for this stock. And this is where you will see that sometimes the stock go down the spiral of correction if the future is not as promising as it was in the past. Well, this is all that I had to cover on this topic. I hope you enjoyed the video. Please take a moment to read this statement and don't forget to subscribe to the channel. Thank you.